610 billion. That's how much money is sitting in UK bank accounts right now. Not invested, not working, just sitting there. 15 million people with more than 6 months income saved in cash. Exposed to inflation, earning maybe 4 or 5% if they're lucky. And the thing is, that number's actually growing. Barclays just released a report calling it the UK investment gap, and it's grown by 30% in just 2 years. So the question is, why are wealthy people hoarding cash instead of investing? What happens when interest rates keep falling, and where should that money actually go? That's what we're breaking down in today's video. Hi guys, I'm Jim Holland from Dan and Jim Property, which I run with my brother in the northwest of England. We buy houses and rent them out either as whole properties or by the room. And I've just completed my first HMO conversion, transforming a 3-bed house into a 6-bedroom property, and raised £160,000 in private investor funds to make it happen. Right now, I'm focused on filling my pipeline with 3 to 5 projects over the next 12 months. And my bigger vision is to create freedom for myself and others through property, whilst providing high quality housing that people are actually proud to call their home. So if you're new here, please hit subscribe, as I break down everything to do with UK property investing so you can make smarter investment decisions. In this video, I'm going to show you the Barclays data on why 610 billion is trapped in cash, and why cash feels safer, but it's actually costing you money, and where that money could go instead. But more on that later. So let's jump into the data. So where does this 610 billion number come from? Well, Barclays released a report in September 2025 calling it the UK investment gap. And the findings are pretty staggering. 15 million UK adults are holding more than 6 months income in cash savings. Not 3 months, not an emergency fund, 6 months or more, just sitting in bank accounts. And the total value of this is 610 billion. And that's a conservative estimate. But here's what's really interesting. In 2022, that number was 430 billion. 2 years later, 610 billion. That's a 30% increase in just 2 years. So why did this happen? Well, the answer is pretty simple. It's interest rates. Think back to the crazy days of May 2022. The Bank of England base rate was 1%. You were getting basically nothing in a savings account. 0.5% if you were lucky. So people invested. Stocks, property, Pokemon cards, everything and anything. Then rates started to climb. 1% became 2, then 3, then 4. By late 2023, we hit 5.25%. Suddenly, savings accounts were paying 4, 4.5, even 5%, risk-free, guaranteed. Just park your cash and earn money. And people responded exactly how you'd expect. They moved money out of investments and into cash. Barclays' own data shows outflows from stocks and shares ISAs into cash ISAs, peaking in April and May 2024. People were actively choosing to take less risk. So now you've got 15 million people sitting on 610 billion in cash, earning 4 or 5%, feeling safe, probably feeling pretty smart. But here's the problem. This safety is an illusion, and those returns, they're about to disappear. And let me show you. If you've got money in a decent savings account right now, you're earning maybe 4 to 4.5%. Risk-free, guaranteed, no stress. And I get why that feels safe, but let's actually break down what you're really earning. Inflation right now is running at around 2.5 to 3%. So if you're earning 4.5% on your savings, your real return after inflation is about 1.5 to 2%. On £100,000, that's 1,500 quid to £2,000 of actual purchasing power gained. Not 4.5 grand, 1,500. And that's today. And here's where it gets worse. Interest rates have peaked, and they're falling. The Bank of England base rate hit 5.2% in late 23, and it's now 3.75%, and it's expected to keep falling. So that 4.5% savings rate, it'll become 4%, then 3.5%, then 3%. Meanwhile, inflation doesn't disappear. If rates fall to 3% and inflation stays at 2.5%, your real return is 0.5%. On £100,000, that's £500 a year of real growth. You're basically standing still. But here's what most people don't think about. The long-term cost of staying in cash. Let's say you've got £1 million sitting in a savings account. Over the next 10 years, rates average 3%. And inflation averages 2.5%. Your real rate return is 0.5% per year. After 10 years, your £1 million has grown to maybe 1.05 million in real terms. £50,000 of actual wealth created in a decade. Meanwhile, asset prices, property, stocks, everything keeps climbing. The people who deployed capital, they're up 50, 80, maybe even 100%. The people who stayed in cash, they didn't lose money, they just got left behind. And investing, getting left behind is losing. So if cash is a losing game over the long term, Where should that 610 billion actually go? Now, I'll hold the hands up, I'm biased, I'm a big property guy. But let me show you why property, specifically HMOs, makes sense for serious capital. First off, let's rule out traditional buy-to-let. I've done a whole video on why the £1 million buy-to-let portfolio is broken, and the link's in the description. The short version is, after mortgage costs, maintenance, void period, and tax, you're looking at maybe a 6 or 7% cash on cash return, if you're lucky. That's not much better than a savings account once you factor in all the hassle. HMOs are a different game entirely. Let me run you through the numbers from a real deal. We buy a 3-bedroom house for £130,000, and the conversion costs, extending, reconfiguring, adding on suites, that costs around £210,000. So the total project costs £340,000. Once it's converted to a 6-bed HMO, we refinance. The property revalues based on its income, not just its bricks and mortar, and we put most of the capital back out. The cash left in the deal around £40,000. Now here's where it gets interesting. The gross rent is £4,100 a month. That's £49,200 a year. After mortgage, bills, management, maintenance, a net profit of around £1,200 a month, which is £14,400 a year. On £40,000 left in the deal, that's a 36% cash on cash return. Let me put that in perspective for you. £40,000 in a savings account at 4.5%, the annual return is £1,800. After inflation, maybe it's £800 of real growth. £40,000 left in a HMO, the annual return is £14,400. That's 8 times more. And that's before capital growth. Northwest Property has grown 61% over the last decade. That £40,000 of equity, that's grown too. Earlier in the video, I mentioned a way to put that money that is in the bank to work better for you to get a belting return. And this is it. 36% cash on cash return. £14,400 a year on £40,000 left in the deal. And you've got capital growth. Rents rise with inflation, but most people hear this and think, great, but I've not got time to do all this. Find deals, manage conversions, refinance, handling the tenants, it's a lot. And if you've got a business to run or a career to focus on, you're not going to drop everything to become a property developer. That's exactly why we built our partnership model. If you're sitting on capital, whether that's 500,000, 1 million, or all the way up to 5 million, and you want exposure to HMO returns without the operational headache, that's what we do. You provide the capital and we can handle everything else. Every phase, every professional, and every tenant relationship. And then we do a 50-50 profit split. There's a link in the description to our investor waitlist. We ask about capital available and timelines. So if you're one of those 15 million people sitting on cash and thinking there has to be a better way, there is. And the link's below. So let's wrap this up and bring it all together. 610 billion is trapped in UK savings accounts. 15 million people sitting on cash, earning 4 or 5%, feeling pretty safe, not necessarily feeling that smart. But inflation is eroding those returns. Interest rates are falling, and over the long term, cash savers don't build wealth. They get left behind. The people who deploy capital into assets that generate real returns, 20, 30, 36%, they're the ones who pull ahead. The gap between savers and investors isn't closing, it's widening. That 610 billion will move eventually. The question is, will you be ahead of it or behind it? So we've covered why 610 billion is trapped in cash and what that's actually costing people. But there's another side to the story. The housing crisis everyone talks about, well, it's actually reversing. 4 consecutive years of improving affordability, wages outpacing house prices, and mortgage rate falling, and yet people still can't buy. And the structural barriers are locking them out. That's creating permanent rental demand and a massive opportunity for investors like me and you who understand what's actually happening. And I break it all down in this video, so I'll see you in there.